All right, well, stocks finished off the week on a relatively surprising high note. Now, we didn't break out, but we did at least finished with a high move at the end of the day that finished near the range, the top of the range of the past couple of weeks, which leads us to a pretty decent probability that we'll break out of that range to the upside next week after Labor Day holiday. Of course, Monday is Labor Day, so there's no video on Monday, no classes of Market Scholars on Monday either. As we've taken off for the holiday, we'll be back on Tuesday with the Market Outlook live video as well, where we take a look at all the old Market Outlook trades. So that will be back on Tuesday as well. But it was a good move. In fact, the late rally in the market produced a very interesting pattern on a signal on the market forecast chart. We'll break that down, as well as other signals that are coming out, including a lot of the buy the dip signals we talked about earlier in the week in the technical analysis class here at Market Scholars. We'll break down the bounce that we've seen in the past couple of days that we were expecting on Wednesday, based off of the patterns that we were seeing, and then we'll talk about what's kind of driving this move, and then a trade idea. It's in the technology space, but not the kind of trade that we've been doing frequently for the past couple of weeks as the market appears to be changing. So we'll talk about how to trade it now in light of the new market trends. So let's go ahead and get started. Today is Friday, August 30th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over on the right, including a Market Outlook live video. This is where I take a look at old trades, see whether we should stay in them or get out of them or not. Come down to the bottom, click this heart. It opens up this tab. And hit that like button that pops up there. Click this thumbs up icon. It opens up this tab. Hit that like button. That should have been popping up there as well. I've got to figure out what's going on with that link there. So thank you to those who do this day in and day out. We really appreciate that. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started on the S&P 500 with the market forecast indicator. As you can see, we finished higher today. In fact, this is not an all-time closing high. We came in right below 56.67, but it is the second highest all-time closing high. So we're just it is higher than any other day these past couple of weeks, even though if we haven't really gotten out of the range, and also higher than any of these closes we had going into the all-time closing high. So pretty good end to the month, pretty good end to the week. Even if it wasn't necessarily a breakout move, it was at least at the edge of a breakout move. It brought both the near-term line, the momentum line higher. This is actually a very good sign. Again, one day, it takes 2 days to get from the near-term line from being below 40 to being above 80, so we can be bullish. And this is the first day, and you want the momentum line to be above the near-term line on the first day. So that's a very, very good sign for the S&P 500 there. Excuse me. Obviously, market sentiment has turned back up. It's rising again. We're back above that 2.5% mark, above the moving average. We're at 3% above. So now the line is clearly green and turning higher. So really, really good ending to the week. The NASDAQ 100 looks pretty similar. Not as great. The momentum line is above the near-term line, on the first day out of bearish territory, but it's got a lot more to go up if it's going to get above 80 in 2 days. So that's something to keep in mind. The near-term line is actually still below the intermediate line. The intermediate line is rising, though, in bullish territory. Its market sentiment line is not rising, nor is it in bullish territory either. So, we do have dark green shading and now a green line, but so not quite bullish as the S&P. Your Dow Jones Industrial Average is looking pretty good. Your near-term line never did get into bearish territory and is back into the upper reversal zone already. Your intermediate line is strongly bullish. Your market sentiment line is clearly rising more than any of the other indexes. Clearly on a bullish trend here. And we did get a new all-time closing high, as well as a new all-time intraday high on the Dow Jones Industrial Average. Your Russell 2000, kind of like the NASDAQ, not quite bullish, but the near-term line is a little tiny bit above the intermediate line, and looks poised to get above 80, barring a significant drop on Tuesday next week. Which, again, there is the possibility because the momentum line's below the near-term line. So that's not the greatest pattern, right? When you first day out of bearish territory, you want the momentum line to be higher. You want the momentum line to be higher than the near-term line, and that's not the case. So there is a chance that the near-term line can peak here, and we can drop on Tuesday. So that's something to keep an eye on for the Russell 2000. There's a higher probability than normal. Now, granted, all the other indexes look good, so if the Russell just follows suit, then there's a good chance we do get above 80 and the momentum line gets up there too, just simply by, like I said, following suit. But just looking at itself, just by itself, the odds of a bearish near-term peak forming here are relatively high because the momentum line is lower than the near-term line there. Let's go back to the S&P 500 and look at the weekly chart since we are at the end of a week. You can see we are back to dark green shading and a green line. We were last week. We're continuing this week. The momentum line is dipping into oversold territory. Technically, this is a bullish intermediate confirmation signal. Now, granted, the near-term line is extremely high, so there's not much of a dip to bounce up from. So keep that in mind. Some of these other intermediate confirmation signals, like for example, here was one there, and the near-term line was high. It wasn't as high as it is now, but it was just barely below the upper reversal zone, and that's all we got from a bounce was that 2-week rally. So keep that in mind. The near-term lines, you would expect it to bounce, but considering the near-term line is so high already, unlikely there'll be that much of a bounce on the S&P. The NASDAQ 100 is a little bit less bullish, of course. Let me get rid of this. As you can see, the intermediate line has turned higher, so we do have dark pink shading and our green line. And the near-term line is up. Again, you have an oversold momentum line, but you don't have the intermediate line very high. And it is below its market sentiment line. Your Dow Jones, remember, is more bullish. Its intermediate line is still also below market sentiment, but it's turning higher again in a very strong near-term level. And then finally, your Russell 2000. You can see, again, still not that bullish. Like the near-term line did jump, so there's a good chance that we'll turn this around to the upside. The near-term line rallied from being below 40 here to 1 week being, and then the second week. Now you can see the 1 week, the momentum line was not higher, and then now the second week, we did get up to extreme highs, but only because it was a down. But that was still a down week, so the intermediate line still below. Now the intermediate line crossed, the near-term line crossed the intermediate line that's bullish, but the intermediate line is still below market sentiment, so we're not quite turned around yet to the upside. So again, we are susceptible to weakness next week on the Russell 2000 as well because of that pattern that we saw, as well as this week being the bullish week, also being a week that we're actually down on the week, slightly, but down. All right, let's go back to the S&P. Now here's the kicker. We got a cluster on the monthly chart, which is fascinating because we were down on the monthly chart, and we got a cluster. So the cluster finished. The momentum line finished at 80.34, so just above 80. The intermediate market sentiment line, is also above 80. So all four lines are above 80. We were, let's see, I guess it was the 5-year. No, it was a 20-year. Maybe it was a 20-year. Yeah, so on the 20-year chart, we are at the 90th percentile of how far up above the 30-month moving average right now. So pretty significantly high with the cluster as well. And remember, I've also talked to you before from a linear regression standpoint. If we look at that same 20-year chart, so do a 20-year linear regression here, and you can see we are also pretty darn high. Like we are up above the second standard deviation channel away from the linear regression. The linear regression right now is at 416. That's based off the trend. That's where the median price is, the best fit trend line, and we are clearly well above 416. Like again, 2 standard deviations above, so very, very high. And again, on a long-term chart, we don't necessarily fall immediately. It's not as it takes time for overbought signals to play themselves out. The longer the time frame on the chart goes. Let's look at some of these other weekly charts. Again, a very good Hakinyashi candle. The size of the candle is down a little bit, but still we got a higher high. We got a higher Hakinyashi close, so we're still good on that. If I look at the whole moving average on a weekly chart, you can see that, again, the parabolic SARS has flipped down. We talked about that last week. The green, the 20-week whole moving average has turned green as we are back up above it. Now this is a little bit of a, something we have to keep an eye on. The size of the candle is pretty small, or relatively small, but we are converging on that 200-week moving average. Now, we can converge for a while, as we saw at the end of 21 going to 22, the last time we were converging. So we were pretty high, well up above it, and we're still in convergence mode now, and we'll see how long that convergence mode lasts. All right, now let's take a look at some of these different daily oscillating charts. 3 green arrows, obviously, across the board everywhere. Green lines now on every one of these charts. Green lines, so that's a very good sign for the S&P. Good volume today to finish up the month. Above average volume, pretty close to average range on the S&P 500. Looking at the 2-line versions of this chart, we're back above the 8-day moving average. Now, something to keep an eye on here is where we are on the monthly candle. Yeah, let's see the SPY up. So generally speaking, whenever you start to show weakness below the 8-month exponential moving average, things start to get weak, right? Things start to get weaker. So we close obviously well up above the, and you can see the MACD is really strong here, so very strong momentum. But we did flirt with breaking below the 8-month moving average at the lows of the month. So again, that's a long lower shadow. That is a sign of weakness. Again, it'd be a lot more bearish if it was a long upper shadow, but still having a long lower shadow there means the bears are there. That's kind of the idea. As you saw in January 2022, we dropped below the 8-day on the lower shadow, finished up above it, and then the next month we dropped below it. Now we were a lot closer. We are quite a bit above the 8-week, or quite a bit above the 17-week. So momentum is pretty strong. But the momentum there was actually pretty strong too, between the 8 and the 17-day, and we started to falter. And you can see other instances where we clipped the 8-day only to come down below it eventually and start to correct. It's usually when actually we start a correction, is when we break below, because you can get pullbacks down to the 8-month exponential moving average. When you break below it is usually when you start to correct. So the fact that we were below it at the lows of the week kind of goes to show how close and how close we were to a correction starting. Barring the Bank of Japan coming in and stabilizing the yen and everything rallying in response dramatically to the upside sense. All right, let's take a look here at the DMI. You can see both lines are below 25. So again, we don't have a trend going. You have to have one above 25, one below 20. Your negative's below 20. So but the fact that they're both falling, now your ADX is below 20. So again, no trend yet on SPY. Of course, things can change, but as of right now, there's no trend. The RSI and the CCI, you are above these 60 levels still. And again, we still haven't gotten back up above the 150 level yet to really signify the beginning of a new trend on the CCI. The Ichimoku cloud is still at weak trending levels. You are above 65, barely, but you're not above 2 yet, so we're still at weak bullish levels, even if you're easily above the cloud and with a pretty strong rate of change there. And then finally, your Bollinger Bands, your bandwidth is really high. So again, it's not impossible. We started the trend back here with a really high bandwidth, and we continued higher. But generally speaking, you like to start your bullish trends when you're a little bit lower on the bandwidth. So it makes it hard to stay up above the upper quartile and stay up there, and makes it relatively hard to get above the upper Keltner channel. I mean, look at all that momentum. This is a lot of, all this momentum got us up above the Keltner channel there. All this momentum also got you above the Keltner channel. Even this strong momentum got you above the Keltner channel. This was more momentum than all of those, and we still aren't above the Keltner channel. So it makes you wonder how much momentum we have left to be able to continue to move up there. You can see we did get a higher high, but we stayed within the range essentially for the last now 2 weeks range going into next week's employment report. If you look at the Russell 2000, here's an interesting pattern. We still don't have a new high on the Russell 2000. We are a lot closer now because the new high jumped, right? But we have the potential of it being a one touch up above 70 and coming back down. And if we don't get a new high soon, then we have to worry about that's a bearish pattern when you get a one touch on the green line. If we fall back down here, as you can see, the red line's already at 0, so the low's already over here, and that's going to start moving up pretty quickly, making it easier to get a new 4-week low point. The range really dropping down. I mean, the range is really high, and to have both lines falling as low as they did before we got this jump, and it was a jump because we dropped from the new high when it came off down to there, but we still haven't, that new high was over here when we got it. That's why I didn't get all the way up to 100. Not the most bullish sign on the Russell 2000. Of course, everything else you did get above 0, but your NASDAQ 100 again got that high point. The red line has hit 0. The green line's below 70. So unless we get like one of these kind of moves here where we jump back above 100 pretty quick, which we can do if we break out above last week's high, but unless we get one of those jumps, then again we are susceptible for a break to the upside, because that's the conditions for the red line to break to the upside. Now again, the low point by the end of next week, the low point is going to be up a lot higher than where it is now, because it's going to be moving up day by day here. So the range is going to start to tighten up. Unless we get a new high, the range is going to tighten up, and we're going to be susceptible to a bearish breakout on the Qs as well. If we take a look at today's range and volume, we saw that we were right above average there, 62 million, a 7-point range. It's not necessarily bringing the ATR down. The ATR appears to be kind of slowing down. We needed to get below 1%, right? Getting below 1% is when things are bullish to the upside and trending levels, and we are clearly well above 1%, and the volume is still relatively high, and the VIX is low, but not dramatically low. It is at the 85% mark. We did finish below 15, or right at 15 on the daily chart there on the intraday, a little bit below. Excuse me. The VVIX at least did finish the week below 100. That's a positive sign. But the VIX still is above its 200-day moving average. So its downside, it's still more susceptible to upside moves right now than it is to downside moves. So we really need to get below these pre-expiration lows if we're going to really solidify the trend to the upside, as well as obviously getting this below the 1% mark. And it doesn't look like we're that close to either one of those. So that is something to kind of keep an eye on as well next week. We really need volatility to come out of the system. Now we have employment report, and we have the employment report, we have the inflation report, and then we have the FOMC. Next, boom, 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 1 week after another over the next 3 weeks. So probably won't come out until we get through that FOMC meeting and we start to get a clear direction on where rates are going to be going here. All right, now let's take a look at what's driving the price action today. You can see the Qs have been the big winner all day today. The IWM has been a laggard, but at least it finished higher. On the other end of the spectrum, crude oil really dropped hard at the open. So commodities in general were down 1%. You can see TLT was down 1%, which again means that yields were higher today. The dollar was higher today. So it's interesting to see strength in yields and strength in the dollar and strength in stocks as a result. That's usually not a strong combination. It's been the other way around. But again, if you take a look at the dollar, remember the dollar had been weak, but finished this week strong, getting up to the 17-day moving average. And now again, it'll be a matter of how, if we can continue to move up, and whether or not the stock market will stay in this negative correlation, right? You can see, generally speaking, a positive correlation where they both move up together. Generally speaking, the correlations between the dollar and the S&P 500 is not positive. It's generally pretty negative. There we go. Sorry, I had it up there for a second. There we go. So you can see generally it's a negative correlation, but the last couple of days they've been, to the point where now the 10-day correlation is not so negative. Still negative, but not so negative there. And the dollar is entering a seasonal period of strength. It's coming off of extremely oversold levels. So we'll see, if it does return or have that seasonal strength, and does it return to some positive correlation with equities as we get potentially, again, it has to get above that 17-day moving average for us to really feel strong about a change in trend. And even then, it's got to get above it and stay above it. And you can see over here, you kind of were running the same thing, and then you finally kind of broke out, and we were able to maintain bullishness. So, and this is the strongest bearishness that the dollar has had since back over here. And we retested with a new low on that second move, and we haven't really gone and retested this really significant lower momentum yet. I mentioned TLT was down, which means that TNX also had a significant. Here, let's pull up the this chart here, and we'll pull up the 10-year yield on this. Eventually, there we go. And you can see it got above its 10-day moving average. So it got up to 17-day moving average. Got up to 3.91%. Excuse me, the MACD and stochastics are turning up. Now, again, that's not necessarily the best sign for equities either. If you look at its correlation with, here, let's do TLT, the bond market, which is falling. Again, it's kind of coming back down to negative correlations, which means that the yields and stocks have a positive correlation, but you can see it's generally been stocks and bonds that have been positive during this inflationary period. So that's an interesting development to see if that will continue to be the case as well. And then finally, I mentioned commodity prices. Commodity prices really had a big down day today. Dropping down 1%. If you look at crude oil really dropped back down, failing at the 30-day and back below the 8-day, and MACD and stochastics rolling over as well, and below the point of control, and below the 200-day moving average, below the 200-week moving average as well, which again kind of shows that crude oil right now is in that bear market, right? Because getting below the 200-week and staying below the 200-week is a sign of bear market. So it's going to be really hard for the economy to, for people to expect the economy to go very well if the demand for commodities aren't very strong, and if they're dropping, crude oil in particular. Now, that will be a great thing for inflation, but it's not a great sign for, again, economic growth expectations, which may be one reason why the 10-year yield is so low relative to the S&P, to the 3-month yield. I did want to bring up a few things I tweeted out here earlier today regarding the rate cut. So in September, the Fed is going to cut rates, right? Why they expect 100% odds. So the question isn't, whether they're going to cut 25 or 50. That's not the important part, right? So right up here, where 5.35 is where we're currently at. In June, these are the projections the Fed had in June. So in June, you had 4 FOMC participants that still said no rate cuts by the end of the year. And one of those 4 said no rate cuts by the end of 2025 either. And then another one only having 2 cuts by the end of 2025. But you can see the consensus was looking for at least 1, if not 2, rate cuts by the end of the year. Obviously, things have changed. So now the question is, where is the Fed projections going to be in September, right, when they release that? Right now, the consensus is that we would drop 125 basis points. The futures market is pricing in another 3 cuts down to here, down to 3.375. So where is the Fed going to be? Is the Fed going to be down here? And just to kind of give you an idea, that's kind of what I talked about here is 200 basis points isn't a lot when you're at a 10% rate or a 15% rate like we were in the late 70s, early 80s. 200 basis points is a lot here at 5.375. In fact, it's 37%. The Fed hasn't cut the Fed funds rate by 37% or more without us being in a recession when they've made those cuts. So if the Fed comes out in September and reduces their odds here to 3.375, then you can see that suggests that the Fed may feel like we are going to be in a recession next year. Now, they won't say that because they can never say that. But their projections might imply that they are expecting that the economy will be in a recession by the end of the year. Now, that doesn't have to produce a bear market in equities. As we saw in 1990, we got a correction in 1990, but we didn't get a bear market. So it doesn't, a recession doesn't have to produce that. But and they did cut rates pretty significantly and during that time frame into 1991 and early 1992. But it will be interesting to see if that's what the Fed is expecting. And to kind of give you an idea of what significance of 200 basis points, this is where the Fed funds rate, or this is where the spread between the 10-year and the 3-month bill, which is the effective Fed fund rate, essentially the market rate for the Fed funds. If the 10-year doesn't drop at all and the Fed cuts 200 basis points by the end of next year, then this spread will get up to where that red line is, 0.65, because we're pretty much at 1.35 now. So we get up to 0.65. And you can see that's not very high. That's not normal for them to cut rates just to get this up to that level. You notice all these other instances, even in 1990, the 10-year yield was about 300 basis points up above. The 10-year yield right now is at 3.86 or around 4%. So for us to get to 300 basis points, the Fed would have to cut without the 10-year dropping at all, down all the way down to 1%. The Fed funds rate all the way back down to 1% there to get this up there. Or the other possibility for this to go up, with the Fed cutting rates in the 3-month, is for the 10-year to go up. And cutting rates is inflationary. But as long as we are in a recession, as long as there's not a whole lot of velocity in money, then it won't be as significantly inflationary because money is just not exchanging hands. But we already know there's a lot of money in the system. If rates start to cut and more money starts to exchange hands again with rates cutting, with the economy as it's been, then there's a good chance inflation starts to pick up again and the 10-year yield starts to pick up too, while the 3-month is falling because the Fed is cutting. And that can make this go up to 200 plus basis points, which you can see 200 basis points is kind of actually the average that this has been. So it is also interesting too to see that when you look at the let's look at, where is it? I've got it up here somewhere. There it is. So here is the Fed funds rate, right? The effective Fed funds rate. And again, if they are widely expected to bring it down here over the long run, right now their expectations is that the long run range of the Fed funds rate will be 2.5%. Well, to kind of give you an idea of how the Fed funds rate moves, you can see it doesn't get to a long run range and stop. When it goes up, you notice it doesn't stay. When it goes down, it stayed down here for some period of time and here some period of time. But you notice it doesn't stay down for a long period of time either. Here's 2.5%. This gray line is 2.5%. So it most likely won't get down to 2.5% and then stay there. And remember, if they do, that's not enough cuts to get the spread here, assuming no drop at all in the 10-year, up to normal levels. So something has got to give. Something has got to give in that case. And again, it kind of goes to show what the Fed is thinking, right? Is the Fed thinking we're going to be in a recession? Is the bond market thinking that we're going to be in a recession sometime next year with how significantly low this spread has been, and now with the spread starting to rise, at least the 10-year, 2-year starting to rise towards zero. So a lot of kind of underlying signs here in the bond market that's giving us an indication of what we really need to be paying attention to when we get to that September FOMC meeting. Not so much the 25 basis point cut, that's not the big deal, or when and if they will do a 50 basis point cut. It is how many cuts do they expect they will make by the end of next year throughout this cycle, and that will give us an indication of how much they think that we will be in a recession by next year. And then of course how that translates to equities, we'll be able to watch to see how the market starts to trade within these next few weeks in light of that first cut and the projections that come along with it. All right, now let's take a look at our trade idea of the day, and I want to stay in the tech sector. We've been so bullish on trades lately, but now things appear to be kind of slowing down their bullish momentum. And so you can see there's a bullish chart here on Qualcomm. The intermediate lines coming out of bearish territories crossed above market sentiment. You got the bear tags. You had been pretty bearish going into that. If you look at the weekly chart for Qualcomm, again, you can see that it's been like we're not bearish anymore, but these aren't really the most bullish candles either. It's kind of a common theme here, right? We're not bearish anymore, but we're not really bullish either. You can see that here. We got 3 green arrows. Again, that's not the most bullish because we don't have a green line yet, and it's only been 1 day. But it also kind of slows the bearish momentum down when you get that signal. If you take a look at the 2-line version of this chart, you'll see that, again, the MACD is neutral, the stochastics is in bullish territory, but we're kind of converging on all these moving averages, still below the 50-day moving average, at the top of the value area, so that's a pretty good sign, relatively speaking. Looking at all these other oscillators, they're all showing very neutral patterns. You're neutral on the both lines below 25, so that's neutral there, with a little bit of a bearish bias. The RSI and the CCI have a little bit of a bullish bias, but still more neutral than they are directional. Looking at the Ichimoku cloud, you can see there is no bearish trend anymore, but we're not bullish either. You are above these lines, you're still below the cloud, you have a small positive rate of change. And then you look at the Bollinger Bands, and you can see that we are right in the middle, right in the middle of a declining bandwidth. It's right smack dab in the middle of its Keltner channel. So when I see trades like that, I think, okay, well, let's come over here and let's do a iron condor spread. We'll sell the 20 delta on this side. It was a 24 delta, I believe, on that side on the 185 when we did it during the Market Outlook Live. So that sets us up for this trade. Again, a normal position size, pretty decent reward. And as long as we stay in this range, around this node that's pretty much developing into the point of control, it's still down here, but the more days that come off down here, the more this will develop into the point of control. And you'll probably get a change in the value area too, where we'll be in the middle of the value area rather than here at the top, right? Because the value area, as this comes off, you'll see it shift up to the upside. So very neutral trade, and we don't have to worry about earnings, and we'll see how this plays out as we go into as we go into the end of this expiration. We don't, sometimes you have to go through like right now, if we could do October, we'd have to go through 2 expirations. Here we just have to go through the 1 over the next 3 weeks. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at marketscholars.com for free, follow and like me on Twitter and Facebook as well. Have a great rest of your weekend and Labor Day holiday, everybody, and we'll see you all on Tuesday.